We're half an hour away from the open in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne. Our top stories this morning. Asian stocks declined to start the week as investors await Tuesday's U.S. CPI print. The yen in focus after Japan avoids a recession and on growing rate hike bets. Some positive signs for the Chinese economy with consumer prices rising for the first time since August, even as PPI remains in contraction.
And I'm Stephen Engel in Beijing, where the National People's Congress is set to wrap up today, signing off on an ambitious growth target after also a renewed warning against property speculation.
Some breaking news crossing from Korea. Now the financial watchdog said it did find a range of instances where some of the country's largest brokers misrepresented some of these risky China-linked structure products to retail investors and retirees. And so this investigation really is what we're seeing here, and some of the conclusions that come out from it, from 5 banks, 6 brokerages, uncover some poor regulatory compliance and systematic failures, I should say, regarding the sale of some of these financial products that have been linked to the HSCEI. So that's according to what we're hearing from the Financial Supervisory Service here on this Monday morning. So certainly that is one thing that we're tracking very closely when it comes to this China story as well, given, we have been wrapping up this MPC later on here today. So a quick look at the market action here right now. You take a look at how markets are set up. Obviously, given that jobs report, it was a mixed one. I mean, it's interesting to interpret that one, given that we did see jobs actually better than expected in terms of job gains, but that unemployment rate was actually at a 2-year high. But we're still suggesting what we heard from Jay Powell stands right now, that rate cuts could be coming soon. So U.S. futures are flat, but we're continuing to track the drop in the dollar. We saw the biggest weekly decline this year for the greenback here. So yields we're ticking lower as well. You take a look at how we're tracking when it comes to the rest of the markets, though. Still seeing a bit of downside, as much as 1% for APAC stocks here this morning. We're focusing on Japan very close, just given what we saw with that fourth quarter revision for GDP numbers. So it doesn't look like there was a technical recession after all. Golden Dragon did this on Friday, and we are continuing to see a bit of risk-off moves across these markets. China futures are doing this here right now. We're seeing very closely, so pretty flat on this Monday morning, 229 for your China 10-year yield. We talk about that yield curve for the 2s and 10s or 3s and 10s or whatnot in China continue to look quite flat here right now. We're going to be talking to our Shuli Ren about whether we will see that inversion like we see in the U.S. 719.53 for dollar China this morning. In terms of your agenda, that's what we're watching out for. Of course, it is the end of the MPC. Talked about that flattening curve for the CGB market. We're in that window for February credit data as well, so watch out for that. There's some chip curbs, also a state fund focusing on the domestic development of chips as well. That certainly is one thing we're focusing on here this morning. Property shares in Hong Kong. We saw another weekend transaction volume surge as well as home sales. Is this a real trend? Is what we're asking right now. And earnings coming through out of Hong Kong as well as with Swire, and we also have Foxconn earnings coming through out of Taiwan this week as well. All right, Steve. He's going to join me this next few hours to really talk about MPC and all things that he's learned for the past week or so. What do we see from policymakers over the weekend, Steve?
Well, I wish I learned more over the last week, and that's been the big criticism, of course, of this truncated NPC. It was essentially 7 days long. Sometimes they're as long as 10 days to 2 weeks. And again, there was no real big policy stimulus. Yes, there was that 1 trillion yuan in special long bonds issued by the central government to help alleviate the burden, the fiscal burden at the provincial level. Of course, they're under extreme debt pressure. We'll talk about that in great detail with our next guest, of course. But again, there was no real big headline. And then we're not having the press conference today, as tradition would mandate, for the premier to kind of flesh out some of the details of their policies. They talked about broad brushstroke terms about high quality development, which Xi Jinping has talked about quite a bit over the last couple of years. And also this new terminology, new productive forces at the provincial and local levels. How are they going going to get, though, from point A to point B to deliver this growth target of around 5% at a time when, yes, CPI did come up in February due to Lunar New Year holiday, but again, CPI deflation had been kind of getting sticky for 5 consecutive months. Of course, at the factory gate, we've had 16 consecutive months of factory gate deflation. So there are definite headwinds, in particular with property. And the one thing that sticks out to me, Yvonne, they really didn't address the property problems. What we got yesterday from the housing minister essentially reiterating what they've been talking about a long time, and that is houses are to be lived in and not speculated on. So it wasn't a medicine for the property market. It was another warning. Don't speculate on property.
Yeah, it's interesting that that was taken out, that line, in Li Qiang's report, but not what we're hearing from regulators over the weekend as well. So a bit of a confusion there. Steve, thanks so much. Let's stick around, and we're going to bring in our next guest, Charlene Chu, Senior China Macro Financial Analyst at Autonomous Research. Charlene, it's always great to have you on the program. You expected the MPC to underwhelm leading up to this week. Has it, or was there anything that stood out to you?
No, I would agree that it absolutely has underwhelmed. Expectations are always high going into this meeting, at least for the last few years when growth has been under pressure, and usually it's a disappointment, mainly because this tends to be very high level and also very fiscal oriented. And so there are certain types of things that just don't get discussed at this meeting, and that usually leads to an underwhelming result. But I think in this particular year, given all of the problems that the Chinese economy was facing, I think it was understandable that we were all looking, like Stephen had said, for something meaningful on property, for something meaningful on consumption, and we just didn't get it. What stood out to us the most is that domestic demand, which was at the top of the list for the major priorities last year, has moved down to number 3. And what has moved into numbers 1 and 2 slots are really related to productivity. And you had mentioned the new productive forces. And I think we are starting to really see the government pivot more to a focus on productivity as the avenue for growth. And that's not necessarily a bad thing. The problem is we still have a domestic and an external demand problem. And if they're going to be focusing on productivity and industrial policy, we really risk exacerbating this overcapacity issue without having done anything about demand.
Charlene, Steve Engel here. So what should we have heard from leaders about the property market at a time, of course, where the troubles are starting to brew at another developer like Vanke, which is state-backed, is the number 2 developer by sales. We've already seen Evergrande. We've seen Country Garden. Country Garden used to be the bellwether. Now it's no longer, obviously. Vanke seen as the bellwether, but now it's seeing some trouble. What should we have heard from authorities?
So we are still very much in the middle of a collapse in the property sector, and this could still get uglier than it already is. And I think at the moment there's an assumption in the market that the levels of activity have come down so much that things can't get much worse, but that's not really true. What you had just said about Vanke is very important because of the state connections of this firm. Both Country Garden and Evergrande were private companies, and they did not undermine the confidence in state-owned developers. That will be different if we wind up in a situation with Vanke defaulting. I think that could really lead to a loss of confidence in almost every developer in the country if state-owned entities aren't safe. So number one thing that we did not hear on property that would have been very helpful is what is going to be done to stem this continued list of new defaulters every couple of months. because this continues to be a real issue. The second thing we have not heard any meaningful information on is what is going to be done to finish the construction of all of these incomplete units. Now, I know the authorities launched this white list this year, and the hope is that this orientation around getting credit to projects instead of developers might lead to a better outcome. But everything we're hearing so far from banks is that there's still just a trickle of money going toward this. So we still have an issue with millions of Chinese people having bought homes ahead of time that don't have them, who are saddled with double home payments, and that of course weighs on consumption, and there's no real solution to that. The other thing is the property bad debt. We have not heard anything about that either.
On consumption then, how viable is it as a potential engine of growth then for this year, Charlene? I mean, it seems to be a lot of debate on whether China does subscribe or wants to subscribe to some form of welfareism, right? Where a fiscal expansion where you do put into the pockets of households. Is that narrative likely to change? Are they likely to shift that narrative, you think?
So at the moment, our forecast for retail sales growth this year is 3.7%. That follows 7.2 last year, which was popped up by reopening. I do think, however, given how weak property sales have been in January and February, and how steep some of the price declines continue to be, there's a real potential here that the negative wealth effect continues to deepen, and that continues to constrain consumption, and that we actually get disappointment on retail sales. If you look last year and you eliminate those months where there was a base effect from 2022, like a Shanghai lockdown, and you strip out catering and restaurants, which were doing really well last year with reopening, the average monthly year-on-year retail sales growth was just 2.6%. So I do think there is a risk that the consumer is going to even disappoint our pretty weak forecasts here for this year, given the way the property market has started off in January and February.
Well, Charlene, tomorrow I'm coming out with a deeper dive in the consumer. And one thing that really struck a chord with me was the fact that the Ministry of Commerce, essentially their panacea for this problem is to do appliance trade-in program. I mean, that's like not going to do it, is it? It's not going to cut it.
No, it is not. And we've had those kind of programs off and on for about 15 years, and they usually only move the dial to a limited degree. They have talked this time about equipment upgrades, so a similar type of trade-in program, but more for manufacturing equipment. But the companies are going to have the money to even be able to do that to begin with. And I think, the payback from this type of initiatives is going to be very limited. We have really not seen anything done about more fundamental things like building out the social safety net so that households don't feel like they need to save as much as they are. And I think that would go a significant distance in trying to help address some of these consumption problems. And then also the issues that we've got with property that are weighing on confidence.
All right, Charlene, hold that. We're going to have more from Charlene Chu there, our China Macrofinancial Senior Analyst at Autonomous Research, joining us here this morning. Still ahead, HSBC explains how China's economy can find a firmer footing this year, with expansion set to be a touch slower than in 2023. That's coming up with Herald Vanderlyn this hour, and next hour, I should say. We're counting down the opens of trade in Shanghai, Shenzhen, and Hong Kong. It's slow going when it comes to risk appetite on this Monday morning. We continue to see downside when it comes to Asia equities. China A50 futures, though, turning a bit positive the last few minutes. This is the China Show. Good morning. Your renminbi fix just crossing the Bloomberg right now, and it is a strong one, 709.69. So we were expecting something around the 710. I believe this is the first time in some time we've actually seen that fixing below that 710 level here. So you are seeing some signs of more support from the PBOC. In fact, that fix has been set the lowest since January, according to my producer here. So this is certainly one to watch here, of course, as we deal with more of this dollar weakness that we've seen actually, and that strength that we're seeing in the currency holding just below that 720 level at 719.43 for your offshore rate right now. It's a big week in terms of data as well. Of course, we talked about the GDP revisions that we saw out of Japan, which, yes, good news for that market. That's why you're seeing that yen continue to strengthen here this morning. The big one is the Super Tuesday. Another one, of course, when we talk about inflation numbers out of the U.S., perhaps it's financial markets, it's Super Tuesday, right? And what this means when it comes to the trajectory of rate cuts as well. We have some unemployment numbers out of South Korea. You have U.S. retail sales and PPI coming out on Thursday as well. And to wrap up the week, we do have that MLF on the 1 year for China. New home prices that come out. Our Bloomberg Economics saying out of consensus, they're expecting a cut this week, despite what we've been seeing when it comes to what we heard from the NPC and the like so far. Still with us is Charlene Chu, Senior China Macro Financial Analyst at Autonomous Research. Charlene, you did talk a little bit more about some of the risks that we're seeing when it comes to developers, especially when it comes to China Wanka. And potentially, if we see a default in that developer, it could be maybe more disruptive than what we saw with Evergrande and Country Garden in some ways. I'm just wondering in terms of the spillover effects. We haven't quite seen that really play through when it comes to the financial sector here right now. It's been quite limited. Can it stay that way in your eyes?
It can stay that way for quite a while if we have the same dynamic going on in the sector. And the top of the list, the most important reason why we have not had a financial crisis, despite 55 to 60 developers defaulting, is the fact that the authorities are allowing forbearance on property developer NPLs. So if you've got a loan to a developer and they're not repaying it, you don't have to mark it as non-performing. Some banks are, but they don't have to. The other main reason why this hasn't led to any big problems yet is because more of the defaults have been on offshore bonds rather than onshore, and there are no cross-default clauses that require Chinese banks to recognize those offshore defaults and mark their own exposures to the same companies as non-performing. Developers in China also only account for 6% of domestic corporate bonds outstanding, so really small share. So even though there have been all of these bond defaults, they just haven't transmitted into the domestic fixed income market in a way that you would think. Now, I do believe that if we have a default by Wanka, that could be more destabilizing than what we've seen with Evergrande and Country Garden. It doesn't mean we immediately move into a financial crisis, but a default by a state-owned developer will really undermine the confidence that there is an oasis in the middle of this property collapse, which is state-owned developers. And that's what banks have been thinking through the last 3 years, but that would obviously change if we started to see some state-owned developers default.
So, Charlene, given that scenario and given how large a proportion property is and land sales at the provincial level is for that growth, how are they going to reach that 5% or thereabouts growth when really at the provincial level, their fiscal situations are so poor they cannot get the property land sales to fill their coffers? And yes, the central government is going to do long-term bonds from the central government, special bonds, but it's only 1 trillion yuan, 139 billion US dollars. It's not enough, obviously, to solve the problem. So this lends to a much bigger problem if those provinces can't deliver the growth that Li Qiang asked them to deliver.
Yes, it does. And our belief is they did not deliver 5.2% last year. They didn't deliver the 4% the previous year. We think that last year nominal growth was 3.3%. Real growth was 4.2%, higher because of a negative deflator due to deeply negative PPI. This year, we're expecting nominal growth to slow to 3% and real growth to slow to 3.2%. So our belief is we are already in a situation where China is growing well below where the official targets are, and we continue to see things slowing. So in our view, there's no way for the local governments to be meeting any of the targets that the authorities have set out for them.
So, I mean, is this a situation, I'm just wondering, in terms of growth drivers then? I mean, if we talk about some of the bright spots of this economy, it still remains EVs, right? High-end manufacturing, the like, which we are seeing China at least widen that gap in terms of what we're seeing in terms of competition. I'm just wondering, are these some of the issues that you're seeing? Can China export their way out of it like they used to? Or do geopolitical tensions really become that big hurdle there to make that narrative happen?
So there's two things going on the export front. So there are definitely some goods where we've seen a lot of strength, and China is really pushing up the spectrum and becoming extremely competitive globally. But many of those goods, the growth rates have already rolled over. So they're still elevated, but they're not as strong as they were 6 or 9 months ago. So that's important to keep in mind. The other issue is what you had mentioned, which is the pushback from other countries. We are starting to see that spread from the U.S. to other emerging markets, as well as, of course, the EU and the recent announcement of potential tariffs on Chinese goods. So the real risk here is we've got an overcapacity problem in China, and it's okay as long as they can take all of this stuff that they have produced that they cannot domestically absorb and sell it to the rest of the world. But if the rest of the world starts saying, no, we are not going to take all of this stuff, then we've got a potential problem where we've got a bunch of excess capacity that has to be cleared domestically, and that basically means closing down factories, laying people off. So that's one of the risks here. Now, all of that said, if there is to be an upside surprise in Chinese growth this year, I think it'll be on exports. And that's simply because the U.S. economy has continued to defy expectations, and exports to the U.S., EU, and ASEAN have all bottomed. So it is possible we could get there. We're just not expecting that as the base case.
Charlene, always great to have you. Thanks so much for staying up for us. Charlene Chu there, China Macro Financial Senior Analyst at Atomis Research. Just checking when it comes to your Hong Kong pre-market here this morning. Of course, we continue to watch what goes on when it comes to stocks. We're seeing up here in terms of upside in stocks. We're up at 0.4%. 80 futures are still in the positive territory here this morning. This is Bloomberg. All right, we are starting to see some price action here in Hong Kong as we count down to your open in just about 4 minutes' time. We're up about 0.4%, 16,416 for your Hang Seng here this morning, 719 for dollar China. HS Tech is catching a bid. Let's take a look when it comes to analyst actions as well. CATL raised to overweight at Morgan Stanley and names it as its top pick, saying the stock is poised to bolster cost efficiency and enlarge its lead in return on equity over peers. ZTE H shares cut to equal weight at Morgan Stanley. Are watching Goldman slashing the price targets of Wuxi Bio, Aptec, as well as XDC. The open is next. This is Bloomberg. Welcome back. You're watching the China Show. We're cutting down the opens of markets, and really after, as we count down to the last day of MPC, markets have actually been turning pretty positive on this Monday morning. You take a look at HSI pre-market is up here right now. We've seen actually onshore outperform a little bit more last week. Actually, HSI, HSEI have been down throughout the last 5 sessions or so. What's really outperformed? It's been the state-owned firms. Materials were also the strongest sector here. What has lagged has been that property sector as well as consumer discretionary. Just give us given some of the disappointments around that work report from Li Qiang as well. So that's what we're contending here this morning, and CGBs continue to show this rally here, and we're going to talk a bit more to our very own Charlene about that possible inverted yield curve that we could be seeing out of China here right now. It's looking pretty flat. But you take a look at how things are shaping up here right now. It is, for the most part, we're seeing some decent green across offshore stocks here. We're up about 0.5% for Hang Seng. MSCI China is also up about 1/3 of 1%. We're flat on the onshore. HS Tech, though, is catching a bit here this morning. Obviously, we're watching very closely. There was talks about the earning bot from CCTV. You know, the interview there was saying that, look, it actually is looking quite advanced when it comes to what Baidu has come out with over ChatGPT. We're watching very closely on 8 shares as well. We're up about 0.8%. CGBs, though, you're also seeing that 10-year around 228 here this morning. There's some strength coming through from the currency. Shanghai crude as well as iron ore, though, still seeing a bit of downfall. Take a look at iron ore. We're down about close to 4% in Dalian. Most sectors in the green, though. We take a look at that. So except for Macau Gaming as well as some of the conglomerates out there, but developers are flat this morning as well. In terms of movers, we're watching very closely what goes on. Of course, this week we had the inflation data, which, first time since August, we did see consumer prices pick up. So what does that mean for the consumer sector? You're seeing slight movement when it comes to Anta Sports, higher smart homes, some of these consumer plays here this morning. SMIC, Hua Hong Semi, there was this report about China readying this state fund to help some of its domestic players when it comes to advanced manufacturing, the like here. So you are seeing the likes of Hua Hong Semi up as well. And then Hong Kong, a busy weekend for real estate agents once again. We're watching very closely. So weekend property deals jumped to a 3-year high. I believe it's the second weekend in a row since this budget came out of loosening these property curves, where we have seen substantial amount of activity when it comes to home sales, transactions, the like. So you are seeing Sun Hung Kai, CK Asset, and Henderson all rallying here this morning. Now, despite Beijing, again, targeting growth this year of around 5%, we have the latest Bloomberg Markets Live Pulse survey really asking what this means, right? How concerned are you about some of the economic and financial problems in China? And it still seems like 55% or more than a majority think that they're still somewhat concerned right now of those spillover effects. The polls have found 30% still do not have any China exposure whatsoever, with another 20% planning to pull back over the coming 12 months. Here's a little bit of what we've been hearing from our guests the past few weeks.
Our view is that one should not invest in China.
I don't think it's uninvestable per se.
High dividend and clients asking for income definitely will still continue to play.
And be very, very careful if you're investing in China right now.
We think the economy is going to steadily continue to slow down for the next 10 years.
I think the biggest risk here is policymaker complacency.
It is not clear what the overall general direction of policy will be long term.
Stimulus is important, but I think China has passed the stage where they want to throw a lot of money, build a lot of leverage.
We're in a new paradigm. The leadership's economic priorities are completely different.
It's very difficult to restore the market confidence.
The sentiment is really bad. I talked to my friends in China, and they're talking about that there is no hope.
I think it's going to be a harder challenge to bring the foreign investors back to China.
All right, for more, let's bring in our Asia equities reporter, Charlotte Yang, and our Bloomberg opinion columnist, Charlene. Charlotte, I'll start with you. What else did we hear in this MLIV Pulse survey?
Yeah, so the latest MLIV Pulse survey, I think the overall is that we're seeing, we have over 230 respondents answer to it, and that includes both retail traders as well as professional investing community. And people are still pretty cautious about the economic outlook as well as for Chinese assets outlook. And one thing that stood out is that you have 3/4 of the respondents saying they're somewhat or very concerned about the spillover effect from Chinese problems to the rest of the world, the rest of the global economies. And also you have, when asked about whether you plan to increase or decrease your China exposure, you have about equal amount that says they plan to increase and decrease. I feel like that shows, even though the Chinese equities have been rebounding over the past months, but because there's not enough concrete actions that shows how China will be able to achieve that 5% ambitious economic growth target from the NPC. So which is why people are still pretty take a step back. And also more than half of the respondents say that they expect the NPC to be not relevant to the equity market in a month's time. And the good number says that there's a risk for Chinese equities to extend into that extended slam as we had with the Japanese market in the 1990s.
And that's why we're seeing this continued rally in CGBs, Julia. I mean, you bring up the chart and show what these yield curves are showing. I mean, it just continues to show how flat this curve is. Could it actually invert?
it's possible. It's amazing that China's sovereign yield curve is flatter than Japan's, which is really quite amazing. And what's happening is that we are seeing a huge rally in the ultra-long end, the 30-year government bond yields. What's happening is that because of the stock market rout earlier in the year and the property downturn, a lot of Chinese households, they're pulling money out of equities and into bond funds. And because of a lack of supply, especially from local government financing vehicles, etc., bond managers, they went into the ultra-long to juice up the total returns.
So is it a sign of recession? Obviously, we've talked about in the U.S. whether their yield curve is, it's been distorted just given what we've been seeing when it comes to monetary policy. But how can we use it as a recession signal in China?
Well, the Chinese government is, of course, very sensitive about that kind of things. They don't like to be jinxed, and they're superstitious, as we know. They don't like to hear the word inflation or inverted yield curve. So what they're doing is they're starting to look into regional banks, as Bloomberg News has reported last week. They're looking into regional banks' bond investment portfolios and to see if there's a speculative behavior, right? But they're also worried that, we have heard so many guests coming to TV saying China being uninvestable because we have a huge asset famine there. I mean, 30-year government bond yield gives you 2.4%. I mean, what's there to invest in China, really? And I think the government must be quite worried.
Yeah, that's below, as you say, some of the policy rates out there as well. Charlotte, I mean, what is your team watching out for post-MPC now? Is this going to be largely irrelevant in a few weeks or time, what we heard from MPC?
I think what we're watching more specific was individual stocks, and because we have the earnings seasons, we're still during this earnings season. And for example, for today, we're watching the solar stocks. They've actually rebounded quite a lot over the past few weeks on signs. People saying that might be the oversupply situation might be improving. We're also watching the EV space. You had the surge, the rally in Li Auto, but that was quickly fading out. And this week you have Expo reporting. So I think it's a lot of single stock earnings, how they are faring, we're watching.
Have we seen any sort of change in earnings downgrades? I mean, have we started to see a little bit more of a change in upgrades in particular sectors?
I think overall it's still pretty, as Morgan Stanley said, they expect, the overall bottoming on the downgrading estimates to still take time because for people to stop that because you're not having enough support from the fiscal side. But I think for individual stock, you are seeing some pretty resilient companies for the different sectors. I mean, going back to Li Auto, I think even though investors seem quite unimpressed with its orders of the new model, they have showed very resilient earnings and profitability despite the price war. So I think that's what's going on. People are watching going forward.
All right, Charlotte. Thank you, Charlotte Yang. There also, our thanks to Shuli Ren joining us from Bloomberg Opinion. In terms of your benchmarks here this morning, we continue to see what's been going on in Hong Kong and Shanghai, and we are seeing when it comes to Hong Kong, we're up some 1% here this morning. When it comes to offshore, outperforming Shanghai on this Monday morning. HS Tech, we're up about 1.6%. Plenty more ahead. This is Bloomberg. Back to our breaking news that across this morning, South Korea's financial watchdog says some of the country's largest brokers misrepresented risky China-linked structure products to retail investors. And many of the customers were retirees, with losses on the complex products now seen totaling more than $4 billion. Let's bring in our Asia stocks reporter, Ishika Mukherjee, more on this. What more do we know on this story, Ishika?
Hey, Yvonne. Yeah, so the Financial Supervisory Service in Korea said today that they found instances of poor regulatory compliance and systematic failures when it comes to some of the products linked to the Hang Seng China Enterprises Index that was sold to retail investors in Korea. And the losses are, as you said, can be as much as $4.4 billion this year. A lot of these retail investors, 22% of the accounts that were sold, these products are for people who are now aged 65 years or older. And most of the buying at that time happened in 2021. These products had a 3-year maturity. But of course, as we know, the Hang Seng China Enterprises Index has fallen more than 50%, lost more than half of its value. So the investors are really holding on to paper losses right now, and the FSS in Korea says that a lot of the brokers, they looked at 5 or 6 brokers, and lenders as well, including Kookmin Bank and Shinhan Bank. Mirae Asset Securities was looked at as well. They said that some of the brokers did misrepresent these products when they were selling them to the retail investors. And this is exceedingly concerning for the regulators right now in Korea.
So Ishika, Stephen Engel here, what does this mean? What kind of remedial steps can be ordered? We do know South Korea is one of the world's largest markets for structured products. We also know that there have been past scandals as well in this area with very complex products being offered. Are there remedial steps that could eventually really punish the banks as well?
Yeah, this is a bit concerning, considering, as you said, there have been past scandals, and regulators came up with rules around consumer protection in 2021 when risky funds were being sold to investors. And so you would have thought that, that we won't see similar situations again. But now it depends on what the compensation is going to be paid out to these retail investors. And the fines accorded to the relevant brokerages will be commensurate to that. If they see that they're compensating the investors well enough for the losses, then I would think that the fines would be less. We're going to see the money that's being paid out by these brokers as compensation being reflected in their first quarter results this year. So they're going to be closely watched. One of the brokers said that compensations of 1 trillion won and above would have a material impact on earnings. So investors are going to be closely watching for those numbers.
All right, Ishika, thank you, Ishika Mukherjee there, our Asia stocks reporter joining us out of Singapore. Your HS Tech is certainly moving here this morning. Take a look at what we've been seeing in some of these tech names, and it's the likes of Bilibili that's up as much as 10 percentage points, I should say, earlier this morning. And you take a look at what's been going on. JP Morgan upgrading that stock to neutral from underweight, saying strong 2024 guidance. You also have new games on the pipeline there and resilient growth in live streaming. That's what's lifting that stock here this morning. You're watching JD.com. Meituan as well, rallying quite hard this morning. And we have focusing on these chips as well. The Biden administration is said to be weighing sanctions on several tech companies in China, including the likes of Changxing Memory Technologies. CXMT is a leading memory chip maker in China and a Micron rival. Let's bring in Robert Lee, our Bloomberg Intelligence senior analyst, still with us. So the potential blacklisting of this company, is it likely going to have a significant impact on the chip sector?
It's probably a little bit too early to say, but sort of taking a step back, the US has been obviously trying to contain China, restrict its access to advanced processing technology, and also through sanctions restrict the ability of Chinese companies to do business with the rest of the world. So we've seen other semiconductor-related companies added to the sanction list, and the CXMT news is just another step in that direction, I think. Will it have a long-term effect? Well, clearly it will curtail their ability to do business with the rest of the world. And the key restriction that China's suffering at the moment, again, is this access to leading-edge process nodes. If you can't produce chips at leading-edge nodes, that will curtail your ability to develop advanced chips, particularly on the AI side. So I think that the long answer, or the short answer to what you just asked, is yes.
What have we heard so far from MPC when it comes to chips? Have you anything stood out to you?
Yeah, I mean, the nature of the MPC is it's quite sort of high level, long-term strategy and objectives. We saw a 10% increase in R&D announced, which is perhaps unsurprising. But I suppose, again, taking a step back, that's China's only option at the moment, is to throw money at the problem. So increasing R&D spending, doubling down on their efforts to try and narrow the gap with the US, if at all possible. What we also saw on Friday was proposed news that maybe China's so-called big fund is going to add another 27 billion of funding in a third tranche to invest in the domestic semiconductor industry. If that's true and it goes through, that would be an approximate 60% increase in funding to the domestic semiconductor industry. So again, China is doing everything it can to throw money at the problem and try and narrow that gap.
Well, Robert, Steve Engel here. Is that $27 billion going to be enough to move the dial? Because I was at all those press conferences here at the NPC, and you're absolutely right. They are talking up sci-tech. I heard the term sci-tech investment multiple times in science and technology, while on the same side, the finance minister was talking about belt tightening on the fiscal front. But sci-tech invest, invest, invest. Is $27 billion going to move the needle, or they need more?
I think ultimately they're going to need more, and it's incredibly difficult for everyone. You know, even if you've got a PhD in advanced semiconductor technology, to try and second guess how long it will take China to break through, you know, to achieve this technological breakthrough. But as I said, I think therefore the only option is to make sure that they're training the right people through the universities and continue to throw more money at the problem. But ultimately, this is a significant multi-year challenge that China's trying to undertake at the moment, again, to try and develop in-house domestic processing technology at advanced nodes.
What about when it comes to earnings? We have Honhai coming up out of Taiwan. AI growth certainly has been one factor. What are you expecting?
Yeah, I think if we'd had this chat on Honhai a couple of weeks ago, it all looks pretty good for Honhai because they had a fairly challenging year in 2023 with inventory correction, etc. And 24 with new products coming out and the inventory correction sort of over. On the face of it, it looks to be a better year. Until about the last week or so, we saw these sort of speculation or rumours coming out of Taiwan that Apple's sales to China are down something like 24% in the first 6 weeks. Now, that is an unsubstantiated rumour at this point, but clearly financial markets have been on that.
Yeah.
And I think, you know, ongoing issues at Apple are likely to remain a drag on Honhai through the rest of this year, given that just over half its business relates to Apple.
Robert, great stuff. Robert Lee there, our Bloomberg intelligence analyst, joining us on all things tech here this morning. And the tech sector will be in focus as one of the earnings come through here with Foxconn reporting, as we've been talking about. We'll also get numbers from battery maker CATL here in Hong Kong, as well as Cathay Pacific. They may extend growth in annual profit. That's according to the preview and what analysts are expecting as well. And we are seeing CATL, one of the big movers, up close to 8%. I think double digits now, 14%. Also getting a bit of movement there in terms of analyst actions for that one. Play more ahead. This is Bloomberg. All right, we're talking about session highs when it comes to Hong Kong here, just about 20 minutes into the trade here, and you're seeing 1.5% to the upside. HS Tech is on fire. We're up at 2.5% for that index. Onshore also picking up a bit of traction here this morning. Where we are seeing some downside is Japan when it comes to equities, though. That yen rally certainly is stoking what we've been seeing right now. That's BOJ speculation here and really adding to this whole GG Press report that they could be scrapping YCC as well as ending negative interest rates as early as next week when that BOJ meeting starts. But take a look when it comes to the rest of the region, though. Despite what we're seeing in Hong Kong and China, the rest of the region is actually seeing some downside here. So the Nikkei is down more than 900 points this morning. ASX 200 also down about 1.3%. We're seeing a dollar yen trading at 146 now on some of those BOJ reports as well. Some other major stories we're tracking for you. President Biden has warned Israel against invading the city of Rafah in southern Gaza as ceasefire talks with Hamas remain deadlocked. Washington had been hoping for a breakthrough in the negotiations before Islam's holy month of Ramadan, which begins on Sunday. Biden says the U.S. will continue to lead international efforts to get humanitarian assistance into Gaza and push Israel for more routes to deliver aid. Australia will scrap import tariffs on a wide range of consumer goods from July in a bid to ease household expenses and business costs. The government says almost 500 of what it calls nuisance tariffs will be abolished on goods including washing machines, toothbrushes, and pens. It estimates companies will save almost $20 million a year in compliance costs. India has signed a free trade pact with 4 European countries that the Modi government says will create 1 million jobs in 15 years. The deal with non-EU countries, including Switzerland and Norway, has been 16 years in the making. India gets private sector investment commitments in return for the Europeans securing easier access to Indian markets and products. Saudi Aramco is raising its dividend despite lower profits to help the government plug its budget deficit. The total payout for the fourth quarter has been set at around $31 billion. If it maintains this pace, payouts for the year will be up 66% since 2021. The world's biggest oil exporter provides much of the Saudi government's income via generous dividends. All right, another check of these markets here. CATL certainly liking this upgrade that we saw from Morgan Stanley here this morning. So they're talking a little bit more about cost efficiency, return on equity lead. It's their top pick right now. We're up close to 9% for the battery maker as well. And we're taking a look at when it comes to broader what's really driving this rally that we're seeing and continuing on this rebound post MPC, or at least the last day of MPC. And you are seeing most sectors are in the green with the exception of energy and healthcare. Healthcare rallied quite a bit last week already, so maybe we're seeing a bit of profit taking there. But it is, mostly speaking, a pretty broad-based rally that we're seeing in offshore markets right now. Take a look when it comes to broader, you're trying to dashboard, and this is what's going on. Hang Seng, clearly the outperformer here. We're up 1.3% here right now. HS Tech is still up some 2%. And we are seeing, though, despite this rally in stocks, CGBs are still rallying, right, which kind of shows two different narratives right now. One is concerned about economic growth in the long term, and yet you're seeing a rebound in stocks. So what does this all tell you about where sentiment is right now? 243 for your 30-year yield. We're down about 1 basis points on your CGBs. All right, GMM looking closely and what's watching out for. It's the inflation print really out of the U.S. that's really going to drive this market here right now. So there's still a bit of nerves out there, despite what we heard from that jobs report, which, had a little bit of everything from the U.S., right? Whether you have jobs that were still, job gains that were strong, but unemployment seems to be picking up as well. And does it at least solidify that maybe we could still see cuts along the way? Maybe June is what people are really seeing as consensus now in some ways. That's what's according to HSBC's Herald joining us in the next hour as well. But it really is Japan, the fears of the BOJ, that live meeting now that really is stirring up what's going on in stocks there. We'll talk a little bit more about the equity outlook with HSBC's Herald coming up in the next hour. You're watching The China Show. Welcome back to Bloomberg, The China Show. Here's a look at the CSI 300 just a half an hour into the session. And we're still seeing a bit of a bid here across onshore, but it's really what we're seeing in Hong Kong, where this rally seems to be on fire here this morning when it comes to the tech space that's really driving the Hang Seng higher as well. Some top themes that we're tracking very closely. It is the last day of MPC, so we'll see what else could come out from this. But certainly we've heard a lot from the work report, the press briefings, and some that happened over the weekend as well. Our Stephen Ingles is still on the ground in Beijing. CPI, so inflation coming back for the first time since August. Does this mean deflation is over? Our analysts and economists say maybe, perhaps not. It's some bit of a seasonal effect there when it came to the Lunar New Year holiday, but certainly watching very closely the numbers there. Japan also avoiding that recession here, so the revised number for the fourth quarter looking better than what was initially reported. And this FSS investigation into some of these products that were Chinese-linked products that really hit a lot of the retirees out there into really totaling quite a bit of losses there. Certainly one topic that we're tracking very closely this morning. In terms of your Asia dashboard, this is what we're looking like here right now. So we're watching very closely the brokerages, the like here, and the effects of possibly of this probe that we're seeing in South Korea. They are all mostly lower here this morning. Asia Pacific, though, is much lower than what we saw compared to what we're seeing in Greater China. So the outperformer still remains Hong Kong as well as the CSI 300. Japan perhaps is the biggest drag on that APAC index, just given what we've been seeing, all the speculation that maybe, according to the GG press, that the BOJ is considering removing YCC as well as negative rates as early as next week. March is certainly live in that way for the BOJ. And you see the yen that continues to rally here. JGB is certainly very much in focus here this morning as well. So most sectors are in the red across the region. If you take a look at it here this morning, real estate, communications seem to be catching a slight bid here, but we're tracking really closely what else goes on. The Bloomberg Dollar Index, for example, we saw a third week of losses for the greenback, and in fact, one of the biggest losses that we've seen last week in most of this year. So certainly that is one that could be helping Asian stocks. Not today, though, seems like, just given the strength of the yen. But you take a look at how markets have performed throughout the MPC, and this is what stood out, really, right? The onshore was what really performed last week. Offshore HSI, HSCI was down. What really was looking good was some of the state-owned firms. Materials was the strongest sector. What did lag, though, was maybe the real estate and consumer discretionary names because, as what analysts were telling us, the lack of details to support both of those sectors was really what investors were looking for in that work report, which didn't quite come through. Let's bring in Herald Vanderland, head of Asia Pacific Equity Strategy at HSBC. They're still keeping that overweight on China. Was there anything from NBC that changed your view in any way?
Not really, to be extremely frank. So the 5% GDP or around 5% GDP everybody was talking about, that's pretty line within the expectations. And for us, it's not the GDP numbers that are really important, but the earnings numbers that are coming through. And for the rest, there was this continued emphasis on where they want to go in the longer run, this focus on high-end tech and renewables and these sort of things. And that's, in a sense, nothing too much new. So for me, it's kind of a confirmation again of where we stand.
What's going to keep this rebound from lasting, do you think? Is it still the policy implementation? Is it earnings that has to come through, or both?
I think a little bit of both, actually. Maybe actually three things, something to add to that. So the policy implementation is important because we now see signs. We had Chinese New Year, consumption was okay. We see signs that things are starting to improve. So we need to see this continue. You just talked about the CPI numbers going up. But these sort of things, that might be a bit of a one-off, though, but we need to see these signs to improve, that what they've implemented in terms of policies is actually working its way through the digestive system. And so that's we're waiting for that. That's one thing. The other thing is simply, we're in the midst of earnings season. We need to see that the earnings are okay-ish. Maybe a little bit not as good as what the market is anticipating, consensus at least.
What's okay-ish for you?
No, I mean, consensus is looking for about 15% earnings growth. I think if you ask people on the street how much earnings do you think there will be in China, they say 0. No, that's not going to be the case either. But if we get something in the low double digits, say anywhere between 10, 11, 12, 13, I think that's even better than what people expect. So there will be a bit lower, but that's something we're waiting for.
Herald, Steve Engel up here in Beijing. Let me jump in and ask you whether this rally that we saw in February in Chinese equities was helped immensely by the so-called national team coming in and propping up the market after January. Obviously, was terrible. 2023 was terrible. What's going to give the confidence for retail investors, the predominant retail investors, to keep the momentum going, especially into like private sector firms? There's been a lot of rhetoric about supporting the private sector, but policy is sort of lagged there.
Yeah. So we have seen these announcements that some national team is buying up the market. If you look at certain things that happen in the market very often in the afternoon, you see a rally. Maybe that is the case. But I think there's something else going on as well. I was in Europe and the US a couple of weeks ago, and a large number, in particular European clients, they were everybody's underweight on China, but a lot of them were cutting their underweight positions in China. Now, what we've also seen is that China started to perform well over the course of the last, 6 weeks or so. We haven't seen a sell-off in the other markets. We haven't seen a sell-off in Japan. We haven't seen a sell-off in India. So that indicates to me that new money is coming to the region that was somewhere else, maybe from US stocks, maybe it was in deposits or whatever. So I have the impression that in particular European clients are cutting their underweight exposure, thinking, sentiment is really poor, things could actually go a little bit better. So there's a technical adjustment taking place. That gives me a little bit of hope that maybe this has got a little bit further to go.
So sentiment you think is marginally better?
Yeah.
I mean, are you starting to see those global funds really come back in a big way?
To say global funds are really coming back is probably a big statement. Yeah. They are underweight and say, listen, we're being really underweight, but this market started to perform a bit. Yeah. If actually some good news comes out, then suddenly this market can rally. And this is an interesting thing. Last year, when we saw companies come out and responding to or coming with announcements on earnings, and they were good, the market didn't respond to that. They didn't reward them for that. They were just sold off. And if you disappointed, you were sold off even more. Now what we've seen, it's early in the earnings season, so we've got to be careful here. But now what we've seen is that companies that respond on the upside and do better than expectations, they really rally. We've had an auto company rallying 25% in a day. Yeah. So we've had a few of these names. So we now see that the market is responding quite a lot to positive news that comes out. And I think that's a shift in sentiment. It's all related. So it's not just some national fund that is driving out the market.
And does that make you lean more towards the onshore market, just given that seems to be where the policy support and implementation seems to be right now? Or is the H-share market still offering more opportunities to you?
I think it's a question, actually, that you should answer with looking at what happens with the US bond market, because the H-share market here in Hong Kong is very sensitive to what happens with bond yields. So if you think bond yields will come down throughout the year, which we think, then the H-share market looks better. If you think, well, you know, I think inflation and growth in the US is going to stay up higher there, the Fed is not going to go so quickly, then the A-share market is probably looks a little bit better for you. But we're in the camp that these bond yields will gradually come down in the second half of the year, so the H-share market should get more support from that. Yeah.
Okay, what could be the best buy right now in China?
I think, well, we're looking at consumption's recovering. We think these bond yields come down. So I would look at some of the internet names. I think that looks interesting. And some of the onshore consumer sort of names. The liquor names, restaurants and these sort of things.
But there wasn't really that sort of lift that was needed from the work report on the consumption space, right? It was all about just trading your old consumer appliances to the new, right?
I think that they could do much more. I mean, China is a savings country. It's not a consumption country.
Yeah.
They save, what is it, over 40% of the income simply goes into straight into the bank and they put it aside. And that's because they're unsure about aging and healthcare and education and these sort of things. I think there's a tremendous ability to grow the economy on that front, but we don't see a lot of initiatives to take there for a variety of reasons. But underlying consumption, it is in certain areas it is recovering. It is not doing too bad. So I think that's where some interesting stocks can be found. Yeah.
All right, Herald, stick around. We'll have more from Herald van der Linde there from HSBC. He is sticking around, still ahead of Bloomberg markets. Asia, we're taking a closer look at Hong Kong's new security legislation as the government looks to fast track that draft law. This is Bloomberg.
I'm honestly paralyzed. I wouldn't know what to point to. This is an ambiguous report.
I would err on the side of this being generally a positive story.
But markets have priced in expectations, and that's why I see this ambiguous as opposed to simply positive.
Nothing is really alarming, but it's headed in the right direction, and I think that's what the market wants to see.
The Fed was looking for some more good news, to quote Chair Powell, and I think this generally gets you there.
Interest rate cuts are still very much in the picture. The market's pricing in the summer, and I think that's quite reasonable.
People love to criticize the Fed, but wow, you know, it's hard to look for fault in their behavior really through this cycle.
Yeah, some of our guests there on Bloomberg Television reacting to the latest U.S. jobs report, which showed a cooler yet resilient labor market. And really, are we finally seeing the cooling effects of what the Fed was wanting when it comes to labor market as well? So we're back with Herald van der Linde, head of APAC equity strategy at HSBC. You look at cross assets and volatility just low across everything. You look at FX, stocks. Do you think there's a bit of complacency out there? Or do you think that there is the trajectory of rates is becoming clearer and clearer for the Federal Reserve?
Yeah, in Asian markets, I don't think there's complacency because we just talked about China sentiment being so poor. But in the US, yes, there was in particular complacency, I think, at the beginning of the year because at that time the market said, oh, they're going to be immediate rate cuts. I think it was March at the time, right? And then 4 rate cuts coming through. That has been recalibrated. It looks like these rates are going to come down, but maybe somewhere in the second half of the year. And the bond yields have gone up and now go down a little bit again.
Do you think Fed rate cuts are probably the thing that matters the most to bringing up volatility more than anything else out there?
No, it could actually provide simply support. I think it would be good for markets if we see these rate cuts coming through because that would then allow these bond yields to go lower.
Yeah.
And that's what really drives markets. Yeah.
You don't think that the Fed's going to cut until June, though? I mean, how are you looking at markets here? Are there certain markets where central banks are going to have to follow the Fed and therefore higher for longer rates for a little bit longer? Or are there central banks and markets that you look at and are saying, look, they might can't afford to wait and they're going to have to cut rates sooner?
Yeah, some of them will wait as long as possible because they probably don't want to move too early. Because if the Fed then decides to say, well, we're going to go somewhere in August, and you've already cut your rate, suddenly the discrepancy and the pressure in your currency could be wide, right? But the one, of course, that stands out is Japan. I mean, they're looking to go in the opposite direction and raising rates. And that would mean probably that a weakness that we've seen in the yen, that could well come an end. We might see a bit of strength in the yen because suddenly, hey, I get less of my money in the US and a little bit more in Japan. So on the margin, that could...
What does that mean for the equity market then?
That would not be good for the equity market. So Japan has been on a tear, right? It's been performing really, really good. But that could just take some of the how do you say that, the zest out of the Japanese stock market. And that would be really interesting. So let's assume this for the moment. Japan raises interest rate, the US goes lower, the yen strengthens a little bit, and it's an assumption that we have for a moment made. The stock market has performed very well on the weaker yen, amongst others. So that could take a bit of the zest out of that. If the money then leaves Japan, where does it go? That's the interesting one. That could bring us back maybe to China.
It wonders, we asked whether it's one or the other, right? Does it go back to China? Does it go to other markets that you think still look attractive?
Yeah, we've done some work on this, and it looks like most of the money that's gone into Japan over the course of the last, say, 4 or 5 months is Asian money. So people that run Asian portfolios, not so much global portfolios. They went in until, say, early Q4 last year, and then the Asian money also came in, and that they have to presumably keep their money in Asia. So if they take it out of Japan, then they have to say, where do I go? Is it Korea, India, or China, for example? Because those are really the big markets.
Korea wants to be like the next Japan when it comes to corporate governance, but it seems like what we've heard so far in the early proposals of this Value Up program is it didn't go as far as the whole name and shame sort of regime that we're seeing in
Japan, yeah.
Is that your take overall so far?
Yeah, I think if Korea is going to embark on a path whereby they're really going to make changes to corporate governance, that it will take some time. And it should, because Japan, to be honest, they started to work on this in, what was it, 2016? They put up this Nikkei 400 index, which became the shame index, as people call it, right? If you get pulled out, you'll be shamed, and this is companies with good corporate governance and these sort of things. So Korea just starts off with that, so we have to give them a bit of time as well. But for the moment, it seems like a voluntary submission of companies to indicate what their plans are to improve corporate governance, these sort of things. I think the dynamics in Korea are very different than in Japan as well. So let's see what happens there. But it's one of the reasons why Korea trades at such a large discount to the rest of the region.
Are you starting to pick out the winners, though? Of what parts of the market actually benefit?
Yeah, what you see in the Korean markets is those companies which so-called low price to book companies, so those that would benefit the most from changes in corporate governance. They are outperforming, although that's flattening out in the last 10 days or so, but they've outperformed. And a lot of banks are running on this because it seemed that for banks it's relatively easy to make some of the changes. Well, if you're part of a large conglomerate, well, then the whole conglomerate needs to sit down together and say, how are we going to do that? So that might take a little bit more time. Obviously,
Korea's benefiting from the AI that like here. I'm just wondering, just given, is NVIDIA still that stock that you watch when it comes to the AI trade in Asia? And with this decline that we've seen recently, do you think that's a sign of a peak in the whole AI trade?
Yeah, well, I always talk my tech analyst, and actually last Friday I had a quick sit down with him, and he says, listen, the momentum is there, demand is good, so it works good. And you look at stocks in Taiwan, some of the semiconductor names there, they have performed so well. Some of them are up 30-35% year to date, all on AI, right? So there seems to be a lot of momentum in that sector. So
markets that you're avoiding right now in Asia?
Avoiding, I think parts. See, if the story is going to be that, hey, in Korea there's a bit of corporate governance change, I think some people say there's not too much else big stories in Asia, so maybe that's what I focus on.
Is that still a big story?
I think India is interesting because it hasn't been sold off as money went into China, so that these two markets are separated. The story in India is still good earnings growth. That's all good. The small caps have really rallied tremendously in India. So we like India, but it's really the large caps we like. I would stay away from some of the smaller names in that market. I think in ASEAN it's really selective because the story is now Japan, as we spoke about. The story is China. India hovers around there for the moment and holds up, and it has already performed. Most people think it's a bit expensive, but yeah, the earnings growth is good. So ASEAN is where I think there's not a lot of attention. Indonesia's gone over the election. It's a good story, but then the other markets, maybe the excitement is a little bit less there. So,
Herald, always great to have you. Thanks for kicking off the week with us. Herald van der Linde there, head of Asia Pacific Equity Strategy at HSBC. We got plenty more ahead. This is Bloomberg. Just in case you've been just watching the China show, and not really watching what else is going on out there, Steve. It's the Oscars that are going on at the same time as well. Just to recap our viewers here. It seems like Oppenheimer is getting some early scoops so far here. So we've heard from Christopher Nolan winning Best Director for Oppenheimer, and breaking news now, Oppenheimer winning Best Picture at the Academy Awards, Steve.
Absolutely. It was almost a clean sweep, except Emma Stone also winning for Best Actress. Great movie. I mean, The Manhattan Project, obviously a very serious subject, but Cillian Murphy did a tremendous job. But we also have some victors in this part of the world. Best Animation was the Japanese film The Boy and the Heron. And also the Best International Film was a very depressing film that I watched last night, by the way. That was... the Auschwitz story, Zone of Interest, about Rudolf Hess, the commandant of Auschwitz. Don't watch it. It's depressing as can be, but a very good movie nonetheless.
Not one to watch before you go to bed, Steve, I'm sure. No. Yeah, so certainly it seems like Oppenheimer is really kind of winning most of this here. Barbie, I believe Best Original Song did go to Billie Eilish and her brother Phineas on, of course, that soundtrack. What Was I Made For That song as well. Great song. All right, so we'll continue to watch what goes on the Oscars here as well, because it looks like we're wrapping up with the announcement of that Best Picture to Oppenheimer. In terms of what the market check is looking like here right now, what's really winning in this market, and it still seems like CATL, that one with an upgrade there from Morgan Stanley, raising that price target. We're seeing the stock up some 8%. ZTE and Wuxi AppTech and Wuxi Biologics and Wuxi XDC, those are all some where we did see analysts were not as optimistic. Jefferies cutting estimates on the headwinds for ZTE. I believe Goldman was the one that was talking about Wuxi and all those three assets there, talking about this U.S. bill overhang really impacting sentiment. So we are seeing all those stocks in the red this morning. And we're watching chip stocks. So NVIDIA was lower. People are starting to maybe take some profits on this massive AI rally that we've seen for that stock in particular. So chip AI stocks seem to be following that here this morning. The likes of SK Hynix is down 2%. Adventa is down some 6%. So certainly that's one to watch here, the AI trade and the like. Obviously, the announcement of the state fund from China and the reports that we've been hearing around that as well, that certainly could be helping to make SMIC relatively better than the rest of the pack here today. All right, some relatively better numbers out of Japan as well, revising its fourth quarter GDP data higher and reversing a quarterly contraction into positive growth, and basically then, which means avoiding a technical recession. For more on how that could affect policy and, of course, next week's meeting, let's bring in our Japan economy and government editor, Paul Jackson, joining us out of Tokyo. Paul, walk us through the numbers.
Well, look, the numbers weren't quite as good as expected, but hey, positive growth is much better than a technical recession, especially when you're a central bank looking to raise interest rates for the first time since 2007. So what we saw was companies were indeed a lot more bullish about spending. Now, so that's good for both investment and the prospects for lifting wage growth this year, which is a key point under consideration by the central bank as it mulls when it's going to pull the trigger on its interest rate move.
Well, Paul, that's the big question. You know, I was there in January. You and I talked about it. They didn't move then. And we were all thinking the points were pointing towards April. But you told me personally, you better come for the March meeting. You better be here. So that's next week. Should I be there? I guess I'm going to be there. Right. And are they going to move?
Hey, look, I think we have, it's more than material risk here. I think it's going to be a very, very close call. If you look at the optics at the moment, you know, we've got this favorable result in the GDP, although there's still, you know, some signs of weakness in that reading, but ultimately it's positive. We're going to have probably a very, very solid wage growth figure coming out of Rengo, that's Japan's biggest union federation. That's coming on Friday. So there's some good numbers there. We've got a lot of market expectation that maybe they are going to go in March. I think when we've got everything pointing in that direction, and hey, Bloomberg reported just last week that there are some officials thinking that March is the time to go. Hey, I think it is going to be very close to call, and I suggest you are here next week.
He's got the clothes for it. He's already in Beijing, so he's got to keep warm in Tokyo too. Paul, walk us through just though what Gigi was reporting earlier, right? The how this is all going to play out. Yield curve control first, and then lifting out of negative rates. I mean, how is this all going to play out in the next few months or so, according to them?
Hey, look, I think there's a chance they might do everything all at once. I mean, the Gigi report isn't really telling us much we don't already know. I mean, the yield curve control is already largely sidelined. They already tell us what amounts of bonds they're buying. So it's a pretty small move, just getting rid of the formal idea that there is yield curve control in place. Are they going to stop buying bonds? Well, no, of course not. There's not actually a great deal from that report to add. So what we're thinking is if they do go in March, maybe
Paul, we gotta leave it
zero
there.
interest rate.
Paul Jackson there, Japan economy. This is Bloomberg. 11:29 a.m. in Tokyo. All eyes are going to be on that yen, really, and what it's doing to this equity market. We're down about 2.5%, 146 handle for dollar yen here this morning on the speculation of what the BOJ could do next week. It certainly is raising a lot of speculation that they may do something, just given what we heard from local reports from Gigi, as we just talked about, those GDP revisions as well. So the economy actually did avoid entering into that technical recession as well. So 146 for dollar yen. We're seeing 2 basis points higher for your 10-year JGB yield this morning. In terms of Asia, this is what the rest of the world is looking like, or the region, I should say. It really is Japan dragging down much of the regional benchmark here. So we're down about 1% to start the week. If you take a look at other markets like China, for example, though it is still outperforming, we've come back off some of the highs already in Hong Kong, but certainly did see some positivity at least there. But most sectors are in the red here this morning. U.S. futures are pretty flat. It's all going to be on the U.S. inflation print on Tuesday and whether we can continue this rally that we're seeing across bonds and whether that dollar decline can continue here. We're holding on to the losses that we saw on the Bloomberg dollar index here this morning as well. Let's get to Hong Kong now. We're saying when it comes to what has been a pretty busy few weekends here, 10 of the biggest residential estates saw transaction volumes rise to the highest in 3 years this weekend. That's according to Centerline Property Agency. Property sales have jumped since the government removed cooling measures last month. Let's get to our Patrick Wong, Bloomberg Intelligence Senior APAC Real Estate Analyst, joining us here. So can we actually see the secondary market? The transactions alike, can they stay this high?
Yes, the situation is that 2 weeks ago we have the budget speech, and then we published research saying that the secondary transaction volume will be going to this year 12-year high, so which is quite amazing, and it seems happening now, right?
Yeah.
We see last weekend we really have strong demand coming back, and we see the pent-up demand basically from lots of potential homeowners that they all want to sell it. But on the other hand, we also have some buyers that is from mainland Chinese. We also see some investors. We also see some end users. They're renting home right now. They want to buy. So that also triggered quite a bit because the budget speech have removed the overhang before. Yeah.
And it's really making, foreign investors looking into this market much more closely, or foreign buyers, as you say, in particular from China. I'm just wondering, is this going to be a real trend that we're seeing now? And what impact is going to have on the property developers here?
I think for the developer side, they also want to attract more demand from the mainland Chinese coming. And we see recently the transaction volume is that there is also certain type of buyers. They buy lots of homes in one go, right? It's one buyer is buying like 5 properties or even more in one go, because in the past there's the restriction. You can't buy more than one, right? You can buy, but you need to pay the stamp duty, which is very challenging. But you don't need to pay the extra stamp duty now, right? So that's why they buy quite a bit of that, like 5 or 10, and then they just rent it out for the rental income. So that kind of a trend will also help the developers to sell lots of, because they have lots of inventory. There's just 20,000 inventory.
So do you expect home prices to rebound as well? I believe last time we spoke to you post-budget, you thought maybe not because, the Fed's still not going to cut maybe until later half of this year.
Sure. We see the situation right now is that we have quite a lot of buyers coming in, but we also see the sellers. right? Developers and also we see some secondary homeowners, they also find this a good opportunity to sell. So that also have the impact on. So volume is going up definitely, but the price we still need to wait until the interest rate cutting, which may happen maybe later this year. So we'll see.
Okay. Patrick Wong, thank you. Our Bloomberg Intelligence, a property analyst as well, tracking all things that we saw over the weekend here when it comes to property. Let's stick to Hong Kong now. The city is working to fast-track new security legislation that would impose life sentences for crimes such as treason and give police expanded powers. Now, the draft law was published and debated in the city's legislature on Friday. Let's get to Rebecca Chung-Wilkins, our Asia government and economy correspondent, joining us now. What is the latest in the status of Article 23?
Yes, well, we have seen this really speed through Hong Kong's legislative system quite quickly. So it's the first time we've seen a bill gazetted and debated on the same day in Legislative Council since the handover in 1997. And those discussions continued over Saturday and Sunday. So debates, lawmakers hard at work through the weekend as well. And one concern that was raised was over the nature of external interference, this concern that this could potentially affect other or any other foreign organizations. Now, Chris Tang, Security Secretary, has been quite firm, saying that, there would have to be criminal intention to the actions for that to happen. So there has been this focus on the nature of motivation and the nature of intention through these debates.
Rebecca, Steve Engel up here in Beijing. Why the rush? Why fast-track this?
Well, we did see this sort of fast track, particularly when it came to those Friday debates after officials at the NPC, where you are covering the National People's Congress, after they urged the passing of this bill. So in part it is coming from the it's direct urging from some of those officials. I think the other element is that in many corners of the business community in Hong Kong, there is this desire for Hong Kong to move on with the discussion, to move on from this focus on national security. Not that many months ago, the American Chamber of Commerce in Hong Kong, for example, reported that 2/3 of its respondents to its survey said that they wanted the Hong Kong government and the US to both sort of move away from this discussion of national security. They thought that would be the most helpful factor in trying to improve relations. So I think there is a desire really to move on to the other big issues, things like the economy, the property market, and so on.
Rebecca Chung-Wilkins, thank you for joining us there on the latest when it comes to Article 23. Of course, you can get an insider's guide to the money and people shaking up the financial hub in our new Hong Kong edition newsletter that's out every Thursday. Make sure to sign up through our website, Bloomberg.com/newsletters. Plenty more ahead. This is Bloomberg. All right, we're taking a look at when it comes to these AI stocks here in particular. It's a mixed picture, but really tracking what we saw with that NVIDIA drop last week as well. So it's kind of seeing a different sort of move. Taiwan Semi is down 2.5% after it reached that record high last week. SK Hynix also down some 2%, but still seeing some resilience when it comes to Wistron here this morning. But your APAC Semiconductors Index is down overall by about 2%. Well, let's talk more about Cathie Wood. ARK Investments' flagship innovation ETF has not held any NVIDIA shares for about a year now. We did ask the CEO, Cathie Wood, whether she regrets that decision and what might change her mind about the stock.
We wrote it most of the way up, but I'll tell you what we did. And this is, as a portfolio manager, it's not one action, but what it causes in terms of another action. Last year, we sold in the flagship NVIDIA and put it into Coinbase. Coinbase, I believe, is up at least as much as NVIDIA. And it is much less well understood. The whole crypto movement, the crypto asset movement, Bitcoin as a new asset class and so forth, is not well understood or completely accepted out there. So we prefer to go where others are not traveling as much. And, you know, as we were moving out of NVIDIA, we were saying, okay, regulators are trying to crush Coinbase here, and we were buying it on every dip. NVIDIA happened to be one of the sources for that purchase. So it's not just what we do on the sell side; it is what we do on the buy side that you have to look at. And yes, we do hold it in the more specialized funds, but we've been taking profits there as well for reasons I just described.
Yeah, and to be fair, you're right. Coinbase is up about 620% since the end of 2022. So that compares with about 530% gain in NVIDIA. Is there anything, though, Kathy, in the NVIDIA story that would make you rethink the name and want to become more aggressive on it?
Yeah, if the price came down a lot, we would. You know, the rate of return expectations
or a split?
We have.
Would a split do it? Because I know we've been
no,
kind of
no.
Okay.
That wouldn't change. That wouldn't change anything. No, no, split adjusted then the price. So, you know, if you look at our portfolios, what we're trying to capitalize on with a Palantir, for example, are the next stages of this AI revolution. What we're seeing in the GPU side of things is NVIDIA, all praise to Jensen Huang. I mean, just unbelievable company execution, vision, and so forth. And it's not over. It's going to last a long time. But there are going to be many other companies benefiting from AI. The productivity lift alone is going to be massive, the most massive productivity lift in history, we believe. And so this AI revolution is going to be broad-based and is going to benefit a lot of companies. On the GPU side, of course, we have AMD as competition, but many people do not understand that there's a lot of other surreptitious competition evolving out there. Each of the hyperscalers is evolving its own chip strategy. You have a Tesla that has designed its own chip for an AI chip for the more specialized autonomous driving opportunity. And I think you're going to see a lot of companies developing more specialized chips. We know that NVIDIA, of course, will segment the market as well. So we just think that a lot of the assumptions for NVIDIA, you know, that this is NVIDIA's market and it's alone, that those are changing.
Kathy Wood there, ARK Investment CEO, speaking to Bloomberg's Carol Massar. Here are some of the other big stories that we're tracking for you in the corporate world. The Biden administration is said to be weighing sanctions on several Chinese tech companies, including chipmaker Changxing Memory Technologies. Sources say the Commerce Department is considering adding CXMT and 5 other Chinese firms to its so-called entity list, which restricts companies' access to U.S. technology. CXMT competes with the likes of Micron, Samsung, and SK Hynix. Bloomberg has learned that Reddit and its investors are looking to raise as much as $748 million in its initial public offering. Sources say the social media platform plans to sell shares in a range of $31 to $34 each, seeking a valuation of as much as $6.5 billion. Reddit has been working toward a listing since its initial filing back in 2021. And a small Japanese plastic recycling company is set to go public via a SPAC merger in New York in coming weeks. JetPlan will merge with AP Acquisition in a deal valuing the company at about $300 million. U.S. SPAC mergers has been under growing scrutiny due to high redemption rates. Japanese firms listing overseas have also seen little success in the past year. Saudi Aramco is raising its dividend despite lower profits to help the government plug its budget deficit. The total payout for the fourth quarter has been set at around $31 billion. If it maintains this pace, payouts for the year will be up 66% since 2021. The world's biggest oil exporter provides much of the Saudi government's income through generous dividends. All right, we got plenty more ahead. This is Bloomberg.
Our view is that one should not invest in China.
I don't think it's uninvestable per se.
High dividend and clients asking for income definitely will still continue to play.
You got to be very, very careful if you're investing in China right now.
We think the economy is going to steadily continue to slow down for the next 10 years.
I think the biggest risk here is policymaker complacency.
It is not clear what the overall general direction of policy will be long term.
Stimulus is important, but I think China has passed the stage where they want to throw a lot of money, build a lot of leverage.
We're in a new paradigm. The leadership's economic priorities are completely different.
It's very difficult to restore the market confidence.
The sentiment is really bad. I talked to my friends in China, and they're talking about that there is no hope.
I think it's going to be a harder challenge to bring the foreign investors back to China.
Some more guests there have been saying throughout the week on China, despite Beijing again targeting growth this year of around 5%. The latest Bloomberg Markets MLIV Pulse survey suggests that most investors remain concerned about China's economic and financial problems. The poll also found 30% of respondents still do not have any China exposure whatsoever, with another 20% planning to pull back over the coming 12 months. So that's certainly still sentiment. We did talk to Herald from HSBC saying that, there is a little bit more in terms of incremental positivity when it comes to sentiment overall. Some of the European sort of clients and funds that he's been talking to are looking a little bit more and dabbing into this market once again. And it's fresh money, he says. It's not really reallocation from other markets in particular. So, that's what's keeping, at least right now, sentiment is looking good. And Hang Seng as well as MSCI China, we're up about 1% right now. HS Tech is really feeling that charge here this morning, although we are still seeing a rally in the CGP markets in some ways as well. Small caps are doing quite well. You take a look at the CSI 2000, we're up about 1% here, but commodity markets seem to be falling a bit. Iron ore, we're down close to 4% in Dalian this morning. All right, let's get to our China brief and see some of the stories that are making headlines in local Chinese media, what's trending on social media as well. Steve, you've been in Beijing all week. NBC's wrapping up today. What are you seeing?
Guess what's the front page news every single day? You know it. It's the NPC and the CPPCC, the advisory body which wrapped up its 7-day meeting yesterday. Of course, it began a day before the NPC last week, and it's front page news. But also, of course, this is the China business news right here, basically highlighting the success, of course, of the CPPCC, the advisory body. But also down here, they're going to trumpet the at least end of 5 months of consecutive deflation on CPI. Of course, those numbers came over the weekend where consumer price index rose a better than expected 0.7%. It's the first time we've gone back into inflation after 5 consecutive months of deflation since August of last year. So they're going to put that on the front page of news. Also, the Global Times, the English version of the Global Times, also talking about the wrapping up of the CPPCC. Tomorrow's headline, I will guarantee you, will be about today's wrapping up of the NPC. But over here, the sidebar, interestingly, is about global businesses draw confidence from the two sessions. The two sessions, of course, is the NPC and the CPPCC, which is known colloquially as Liang Hui. I just want to read you, Yvonne, if I have the time, the nut graph, if you want to call it that, of this story. The growing optimism among global business in the Chinese economy offers firm rebuttal to a smearing campaign among Western officials and the media outlets aimed at discrediting the Chinese economy. I don't think we're doing that one bit. We're just seeing what the numbers show us.
Yeah, or just telling us what the markets are doing, and certainly asking the questions to those global Western fund managers and the like here, Steve. But yes, it's interesting to see some of the positivity that's coming through from MPC, as well as those inflation numbers that certainly, is one, data point going to start a trend. Certainly from Bloomberg Economics, they're saying not quite, given the seasonality of these numbers, but certainly there is some positivity, at least for that month so far. Some more reporting that we're seeing out of the MPC, though. We're seeing the China Securities Journal is quoting industry insiders who say venture capital and equity investment should be developed. And I say bond financing tools should also be better used to boost the development of these buzzword, new productive forces. And that's the latest phrase from Chinese President Xi Jinping, and covers advanced sectors such as EVs as well as renewable energy as well. On Weibo, there's been some chatter growing after 3 NPC representatives proposed raising the threshold for personal income tax. And one of them is the chairwoman of Chinese home appliance giant Gree, Dongming Zhu. Now, she suggests it could be raised to 10,000 renminbi. The current monthly individual income tax cutoff, mind you, stands at about 5,000 renminbi. So that's quite a move there. Now, some have pointed out that workers in big cities may actually benefit the most from this. That's because the proposed tax threshold does not take into account the wage differences between first, second, and third-tier cities. Other users, though, think the suggestion could be a good one. Well, yeah, what do you think, Steve? A lot of chatter there on that one.
Yeah, there was a lot of chatter, actually, all about some of the reforms in the urban cores of China, because there still has to be urbanization, but it becomes a little bit more painful when the economy is suffering. And one thing the NDRC talked about last week was essentially allowing the 179 million migrant workers or thereabouts to have hukou, which is the household registry in the cities that they're working, which could be a continued driver for urbanization, which has slowed, obviously, as more people have over the last several decades moved into the cities.
Yeah, ways that they have to reach that, 12 million jobs, urban jobs, was what they set for the year as well. But certainly,
very
as we track down,
target.
Very on the back of that 5% growth target as well. So as we close the curtain on NBC, there's really a lot on tap for investors here this week as well. And the U.S. CPI print is to be front and center as early as tomorrow, right? Because you have the U.S. CPI numbers come out. So after that mixed, ambiguous sort of jobs report that came out on Friday, is the U.S. CPI print going to be the next sort of event risk out there, and what some are even calling the Super Tuesday for markets here, and whether this really does solidify what we've been seeing here and what the Fed has been chiming in, that rate cuts are coming. Maybe it will be the back half, but they are coming. We're also looking ahead at some retail numbers of the U.S., retail sales, PPI numbers, South Korea unemployment numbers, some inflation numbers out of India tomorrow, as well as PPI numbers out of Japan as well. And keep in mind, wage negotiations, Toyota is in particular very much in front and center here in Japan as well, on any sort of progress in terms of wage gains and the like that could really continue the speculation on what the BOJ could do next week. In the wrap of the week, we got the one-year MLF. So Bloomberg Economics, they have an out-of-consensus call. We could be seeing a cut from them on that front. That's according to BE. We have new home prices coming out, U.S. industrial production, some trade data out of South Korea as well. So it's busy. Earnings are pretty busy as well. Particularly how markets are playing out here. We're still seeing some downside when it comes to Asian equities. It's really what this pullback in Japanese equities that we haven't seen for a while now that's really dragging things down. So you are seeing the topics at least drop quite a bit, along with the Nikkei, about 2% or so for the Nikkei 225. And really the chip stocks are basically playing out in that way, where chip stocks in Japan are falling, but you're still seeing some bifurcation in some of the other AI plays out there here today. We're watching solar stocks in particular as well. JP Morgan positive on the outlook when it comes to installation of these solar projects. So you're seeing like the Shenzhen Kadali industry up some 10%. And we're watching China Wanke, some of the country gardens, the property developers in China as well. So Wanke, there's been some concerns about, overall, is this the next developer to default? Right, we were talking to Charlene Chu from Autonomous Research saying if it does, might have bigger implications than the likes of Country Garden and Evergrande, just given some of the state-owned sort of dynamics of that property developer. Guys, can we flip the boards? Yeah, there you go. So China Wanke at least is rallying after depositing a coupon there for one of those notes there. So at least we're seeing that upside here today, and as well as watching out for the Hong Kong developers, just given the crazy sort of transactions and buying that we've been seeing for the last 2 weekends now. GMM is looking like this here. A bit of a back foot when it comes to risk assets here today, as we, of course, count down to that U.S. CPI print. That is it for us here on the China Show. Movement Markets Asia is next.